Behavioral finance actually combines two different disciplines, economics and psychology, but it's really the study on how we think. And over the years, they've discovered a number of different biases that people have that lead them to making investment mistakes. And at Richardson GMP, we focus a lot on behavioral finance and trying to help investors avoid some of these pitfalls. So biases aren't actually necessarily bad things. They're actually shortcuts in our minds that help us deal with everyday life. But when it comes to investing, they can often mislead us. And over the years, they've researched many different biases, from status quo to loss aversion to confirmation bias, and many others. And all of these impact our decision-making process. And they lead to things like loss aversion, where we really just don't want to lose money. And what that does is very often it causes us to make mistakes, either holding on to investments too long that are going down, or capitulating near market bottoms and becoming too conservative. Confirmation bias is actually one of the most prevalent biases out there in the world, and it's everything not just in the investment world, but we actually like to listen to opinions that reaffirm our pre-existing views. Now, that's great, but the problem is you also are ignoring contrary views, and this can lead portfolios to be too concentrated in certain sectors, certain companies. It can also lead you to missing when things start to change. Over the last number of years, we've researched a lot into behavioral finance and into these specific biases. And what we've come up with is a number of different tools to help investors avoid making behavioral mistakes in the marketplace. You can find this at richardsongmp.com, and we would encourage you to take a look at the different reports we've written. After all, if you become a better investor, it's better for everyone.